Welcome to the Swiss Association of Market Technicians, SAMT. Today we have an interview with a market practitioner and long-time supporter of the society. So welcome, Jean-Francois, to our part 2 follow-up interview.
Yeah, thank you very much, Ron.
And today it would be great to recap on your methodology before we start to have a deep dive into the market views that you have.
Okay, well, let me get on to it. So our methodology, basically we try to answer 3 questions. Where is the trend going? How much potential or risk is there in that trend? And finally, when do we expect the important inflection points to happen, either through a top or a reacceleration of an uptrend, for example. And so for that, we use 3 indicators. First, on the right-hand side, we use trend direction. And for the trend direction, we have standard deviation envelopes. So we have a larger envelope, which is the yellow one, and which gives us the long-term direction of the trend. And then we have a shorter-term envelope, which is the white one, and which basically tells us when the short-term trend has gone too quickly in respect to the long-term trend. And when that happens, the small envelope touches the large envelope, and we have a point of exaggeration, which we call market stress. And so here you have several examples on the S&P 500. Back in 2007, we were in an upside exaggeration. Back in 2009, we were on the downside exaggeration. Then we also use price targets, and we base them on the width of those standard deviation envelopes. So it's a historical measure of volatility, and we factor it up either by a corrective or an impulsive factor, depending on how advanced and how stable an uptrend or a downtrend is.
Now, one of the areas that we spoke about in our first discussion was this idea of overvalued and overextended bull markets, such as the equity market, let's say the US as a case in point. How does that change the cycle? Does it create a skew to the upside?
Well, at the moment, and you'll see in the slides I'm going to show afterwards, the S&P 500 has reached our impulsive targets to the upside. It hasn't made it widely above them, and it's to a point where those targets have been met and the risk reward is not that interesting anymore. And finally, I'll end on the last element of our methodology, which is the timing. And instead of using one oscillator, which would be the black one here, we use 2 other shorter-term oscillators, which are the red and the blue. And that allows us to give us an early confirmation of trend reversals by using shorter-term price frequencies, and also to understand what happens between an overbought and an oversold situation, or vice versa between an oversold and an overbought, trying to catch intermediate lows and reaccelerations into the trend.
Great, and looking at the S&P 500, be great if you could add some more clarity.
Okay, so the S&P 500 here, on the middle chart you have the price surrounded by 2 standard deviation envelopes. As you can see, for now the trend is still uptrending, but the smaller envelope has recently touched against the larger envelope, which is a sign of exaggeration, and that we're slowly getting to a point where we could see an intermediate correction. On the target front, you could see that the targets we calculate are labeled done. That means that price went up and met those targets and has since been not doing much anymore, which means that we believe that this uptrend since 2009 is probably getting towards exhaustion.
Now, what does that mean in terms of price magnitude?
In price magnitude, we'd probably consider here a corrective move to the downside, but given that this is a very long-term chart, if we do calculate it based on our historical volatility, that implies that we could expect over the next 2 years a possible correction of 20 to 35% on the S&P 500.
And most bear contractions, on average, take around that amount of time.
Amount of time and amount of price scope also. I mean, given the huge bull market that we just had, it would be fairly sound to have that kind of a correction.
Great, and just as a follow-up on that, if we look at the dollar as a case in point, how does that fare for the dollar?
Well, in our view, the dollar, it's coming out of an uptrend which lasted between 2011 and late 2016. And the strong counter-trend move that we saw last year, we believe is a counter-trend move. And it actually came down, as you can see here on our graph, and kept the support of our corrective targets to the downside. That means it never went impulsive, it never created a very strong downtrend. And in our view, that support, which held earlier this year, should continue to hold, and our timing oscillators are suggesting that the dollar index could continue to move up at least over the next few quarters into early next year and possibly into 2020.
Now, this is quite an important call that you're making because it's proven to be a pain trade to most people. And year to date, we're 10% up. So, of course, we're looking a little bit exhausted on the short-term side, but you're actually calling for a continuation once this short-term corrective phase is over.
Well, we believe that the corrective phase that we currently see in will probably find a support point towards the end of this month.
Okay.
And then we'll have a first move up into October, perhaps a bit more retracement into November, find a second support at that stage, and then accelerate up towards the end of the year and early next year.
Now, just for some of those traders watching, what would be your risk level to the downside on the dollar view?
Well, on the dollar view here, in terms of a retracement, we could probably expect another maybe 1 or 2% into the end of the month. That's probably where our risk is at the moment. So it is probably between 117 and 119 on the euro. So we met the 117, we could probably make it up to 119.
Great, and as a follow-up to this chart, what other interesting setups are there?
Well, we look at oil, which we believe has been very emblematic of the reflation trade over the last 2 years. And it's still corrective in our view. It had a price target between 72 and 96. But on both oscillator series, we are seeing intermediate tops materializing as we speak. And so we would expect 3 to 5 quarters of correction here and possibly a move on Brent back to the low 60s, high 50s over the next few quarters.
And how does this fit within your business cycle view? So do you see this as a late cycle play?
I think oil was probably a late cycle push from 2016. It has gone its way for now and has reached an intermediate top. And a top in commodities is usually quite significant of a very, very late cycle environment.
Great. And just as a roundup to your market view, any other additional points you'd like to share?
Well, what we would want to say is that in conjunction with that, seeing oil topping out, we believe that rates are probably in for some retracement towards next year, probably on the 10-year US, probably between 60 and 100 basis points. So not new lows, but a good retracement. And if we had to give one suggestion to asset managers is over the next, into 2019, you'd probably need to favor defensive sectors versus the market.
Thank you very much, Jean-Francois, for your market roundup, and we look forward to our next session. Thank you.
Thank you very much, Ron.